Okay, so welcome to this session that is called Easy Finances for Your Startup with our guest speaker, Romina Ferreira. She is the Global Upstream Investment Analyst at the International Finance Corporation in the World Bank. First, let me say that this bootcamp session is taking place in the framework of TIC Americas. We are currently in the 16th edition of the competition where we have three categories, the Innovation Challenge, the Eco Challenge, and the Antique Jalisco. If you haven't registered yet for these competitions, we really encourage you to do so in ticamericas.net. So when you register, you will have like multiple access to these bootcamp sessions and to many other resources that we have created to you to help you in this entrepreneurship process. Okay, so now let me introduce our guest speaker, Romina Ferreira. As I said before, she is the Global Upstream Investment Analyst at the International Finance Corporation in the World Bank. Previously, she also worked at as an economic consultant for strategic planning and development effectiveness at the Inter-American Bank of Development. She was also a business analyst for other banks in Argentina and Asia. Romina earned a bachelor's degree in international business from the University of Montevideo in Uruguay. She holds a master's degree in international economics and finance from Johns Hopkins University. She is a Fulbright scholar and she was a student in King's College at the University of London and in the Hong Kong University. I also want to remind you that you can follow us on social media. You can also send us email and we'll be happy to answer all your questions. You can visit our websites at YABT.net or ticamericas.net. And thank you so much for being here. And Romina, the floor is yours.
Can you see my slides?
Yes, we can see them.
Okay, perfect. Okay, so let's start with this. The workshop today is about some easy finances for your startup. What I want to, my objective here is for you to walk away with a very basic concept of accounting and what are the three statements that you need to have in order to get financing, but also to understand better the situation of your company. So with that, I would like to talk about the income statement, the balance sheet, the cash flow, show you an example of these three statements and go for questions. So first of all, what is a balance sheet? The balance sheets show the situation of the company in a specific time. It has three different components. The first one is assets, and then there is goods and rights of the company. Actually, the goods it's just the assets of the company, and rights is all of those like loans that you have given to other people, for example, your clients. Then liabilities, debts and other liabilities of the company. Equity is the investors' equity and the reinvested earnings that you might have from previous years that you decided to invest in the company again. What is an income statement? Well, it shows the evolution of the company over a period of time, but the balance sheet, you're going to see it usually at the time where your fiscal year is ending, or for it can vary. I mean, it can depend on which are the laws of your country. But for example, at the World Bank, the fiscal year ends at end of June. So that's at the end of June, that's where we see what is our balance sheet, how many assets we have, how many liabilities, what is our equity. But in the income statement, you look at the company over a period of time. So usually that period of time is 1 year, shows the evolution of the company over that 1 year. Then you have the sales, which is the income generated from core business operations. Then you have variable costs that are the cost of production materials and human resources. And you also have other um, administrative expenses. Okay, this is I think I had an issue with the slides. So what is the cash flow? The cash flow is showing what is the, let me stop sharing. The cash flow is going to show you what is it's the flows of income that your company is generating, and what are your actual income and expenses, to understand if you're able to, for example, pay the like the principal of your debt, or if you're able to affront your company's need for capital outflow. So if you give me 1 second, I'm gonna pull up an example. Okay. So first of all, and for this, I think it's very important, especially for the TIC Americas competition, is that you have very clear um, what are your fixed costs and your variable costs. So to begin with, your fixed costs are going to start with wages, PP&E, which is plant, property, and equipment. So any fixed equipment that you have, I don't know, for example, in the case you are starting a bakery, that would be an oven, right? Or any kind of equipment you may need. Then it's marketing expenses. Are you seeing my Excel, just to make sure? Because I see that that I'm screen sharing. Okay. Then you would have to include any services like accounting, legal, and that would add to your total fixed cost. Then in terms of variable costs, you would have an estimate of what is the amount of produced units you're going to have per year, and then how many what are the costs of the different inputs you need to produce that amount of units and per year, right? And when you add all of that in a year, you would have your total variable costs. And again, when you take that total and divide it by the amount of produced units, then you would have your variable cost per unit. And here I think that it's super important to calculate what is your break-even price. So here what you're going to put are different prices, different options for prices. And this is a very simple calculation to calculate what is your break-even. So at which price you're not making any money, but you're also not losing money. You're gonna take your total variable costs, and you're going to add your total fixed cost, and then you're going to divide by the price. And that is going to give you the amount of units you need to sell in order to break even, right? So not to earn any money, not to lose any money. And then another like nice ratio you can calculate is your operating margin. So your operating margin is going to be your price minus your variable costs over your total price. So there you're gonna have how much is the amount you're earning over the price, right? So if it's at 10%, 20%, 30%, you're gonna get it from there. Now from to calculate the three statements, how to, and this is again, this is very general. You might not have a lot of these inputs in your statements because I don't know, you're instead of selling a good, you're selling a service, then it's fine. But this is the general idea that you need to have. So first of all, there is an accounting concept called depreciation. That is, again, it's an accounting concept. And what it tries to show is how your equipment are losing value over the years. And why are they losing value? Because of course you're using them, and then after, I don't know, let's say 5 years, you're gonna need a new one, right? Because after 5 years, an oven can break or it's not baking as good as it used to. So this concept allows us to um, assign the cost of using those equipments. Then PP&E, again, is property, plant, and equipment. So anything that you need for creating that equipment. Then you have a tax rate, which is going to depend on your country. In the US, usually they use 30%. Then interest rate, which is the rate, and this is a reference interest rate. So this is the rate at which the investor is going to um, compare you with, right? So if the investor wants to invest in your company, there is an opportunity cost because they could be investing over the same time in, for example, the stock market. So they're gonna use that interest rate of how much they could be earning in the stock market to compare it with your earnings. So this is that interest rate. Then for the first year calculations, we're going to have the revenue, which we have it from the previous slide. It's just the price that we choose times the amount of produced units in the year. And of course, we're assuming that we're selling it all. Then we have the variable costs also that come from this tab. Then we have other costs that also come from these tabs. This one, the total fixed cost. Then we have profit margin. Again, it's the one that I was calculating here. So price minus variable cost over price. And then we have the interest expenditure. So before it was the interest rate, which is this reference rate for the investor. Interest expenditure is actually at what interest me as a company, I can borrow. So let's assume that you already have $1,000 of debt, and then that would be which percent is my interest on that $1,000 of debt. Then the net profit margin is similar to the profit margin, but in this one, we also take into account the fixed cost. So this would be a little bit lower. And then we have debt repayment and how many years we're saying that we're repaying those $1,000. Then inventory turnover days. These three, inventory turnover days, days receivable outstanding, and day payable outstanding, are three ratios that we use to estimate our inventory, our receivables, and our payables based on parts of the income statement. So I say that, for example, my inventory takes 3 days to sell, right? So here I'm gonna put 3 days. And then these ratios are also very useful for you and for the investor to know how efficient your company is being, right? Because if you, it depends on the industry, but if you are in, I don't know, like very high-end cars, I don't know, I don't want to say any brands, but you know, like a very expensive car, then the inventory day is probably going to be very high, right? Because you're going to have those cars standing in your inventory for a long time before you sell them. But if you are in, for example, consumer goods like pens, then probably you don't have inventory for a long time because one would assume that you're going to sell that inventory pretty fast. Then we have days receivable outstanding. This is in the case that you are selling and your customer takes some time to repay you. So you're gonna put how many days you have to wait until your consumer pays you back. Then you have days payable outstanding, and this is for your suppliers. How much can you go? How many days you have to pay them back? And a very important part for your investors and for your bankers is to see the outlook for the next years, right? So these are inputs that you need to forecast how your company is going to look like in the next years. So first you have revenue growth, then you have profit margin growth, then you have the percentage of the dividends, how much of your net earnings you are going to give back to the investors, and then you have your costs growth, how much your costs are going to grow. Revenue growth, if you are a startup, we would like to see um, a big percentage there. Profit margin growth, of course, we also would like to see a big, I mean, not a big, but at least we would like to see your profit margin growing as you become more efficient. And then in terms of cross growth, in countries where there is um, a lot of inflation, you would like to at least put your inflation rate. Okay, so now to the financial statements. Here we put the currency, in general is US dollars for these examples. And then first of all, we would have the income statement. So your revenues, your cost of goods sold, that revenues minus cost of goods sold, you have your gross income. Then if you take out also your other costs, which are the selling and administrative costs, you would have your EBITDA. So this is earnings before interest, tax, depreciation and amortization. If you take also your depreciation, you're gonna have your EBIT, which is earnings before interest and taxes. And all of here, I mean, I have all this error coming up because these are all my formulas, right? Then we have interest. So here you would put how much you pay on interest, and this is calculated by what is your outstanding debt times the interest rate that you would put in here, interest expenditure. And then you have your earnings before taxes. Yeah. For your taxes, you're going to take earnings before taxes time the tax rate, and that is going to help you calculate how much you have to pay on taxes. And then when you take that out from the EBT, then you have your net profit. And from there is where you're going to calculate how much you pay on dividends. So you take your dividend rate and multiply by your net profit, and then you're going to get how much you're going to pay. So if your net profit is 1,000 and your dividend rate is 10%, you're going to pay 100 to your investors, and then that 1,000 minus the 100, those 900 left are going to be your retained earnings in case you want to reinvest them for next year. Okay, so balance sheet, we're going to have, first of all, what are our assets? And in assets, you have cash, you have accounts receivable, you have inventories, and if you see in here, I put some yellow, these yellow boxes, because for the income statement, we had all the calculations we had done in this previous tab. But for the balance sheet, we don't have that. So in these yellow boxes, you're gonna put what is the status of the company at that time. So if you're doing this balance sheet 1 year after you open the company, or three months later, you're gonna put how much cash you have at that moment, how much is your accounts receivable. So how much did you finance your clients, or you're waiting for them to repay you. Then in inventories, what is the value of the inventories you have standing. And when you add all of this, you have your short-term assets. Then in terms of long-term assets are your property, plant, and equipment that we were mentioning before. Let's put this so it's more clear. So any equipment you have, this oven if you're baking, in order to be able to produce your product. So if we add the long-term assets plus the short-term assets, you have your total assets. Then in terms of debt and equity, we have accounts payable and any short-term debt you have. So accounts payable again is how much you owe to your suppliers. And then your short-term debt is the portion of the loan that you took from the bank that is due this year. So if you have a loan of 1,000 and you're repaying in 3 years, then those 333 that you need to pay in this year are going to come here. Then you have the long-term debt, which is the part of the debt that you're not repaying this year, but in the next 2 years. So that would be 666 in the case that you made 1,000. And then we add these two, the short-term debt and the long-term debt, and we get the total debt. Then shareholders' equity. This could be you, your partner, whomever invested in the company in equity. So you have to put there how much is the equity the company has. And then the retained earnings. This is in the case that you already had 1 year of operation and you decided to reinvest your earnings, then we put them in here. And when you add all the total equity and debt, so everything that you have in shareholders' equity plus the total debt, it has to be the same that you have in assets, right? So here is the balance. All my equity and debt has to be the same that my assets. So everything I have on assets, I have to be able to justify with equity or debt, because somehow I was able to obtain those assets, right? And in order, this is one of the most important parts for the investors and for those that are going to finance you, the cash flows. So cash flows, we have three different parts. The first one is the cash flow for operations. Are all the cash flows that are generating by your normal business. Then you have cash flows from financing and from investments. So from your cash flows from operations, you're gonna have your revenue. You're gonna add back your depreciation, because again, the depreciation is an accounting form of assigning a cost, but actually you don't have any outflow of money because your oven is getting old, right? So you're gonna add that back to reflect that you still have that money, that cash, and then you're gonna also make some adjustments in terms of accounts receivables, account payable, and inventories. Why? because if in the balance sheet I say that that I have, for example, $200 of accounts receivable, but not last year I had $400 of accounts receivable, then it means that I actually got $200 in cash, right? That I was able to charge $200. So now my company has $200 more of cash. Then it's the same for accounts payable, but the opposite. So if before I had $200 of accounts payable, by now I have $400 of accounts payable, it means that I was able to retain $200 in my cash uh, that eventually I'm gonna have to pay to my suppliers, but as of now, I do have the cash. And then in change of inventories, same concept. And my cash flows from financing. Here I'm gonna have my debt repayments and the dividends. And then in investing is any cash flow that you generate from any investing activity that you may have. But we didn't include anything in this example because we assume that you're on a very early stage. So we assume that you don't have any investing activities as of now. So here you're gonna add what are your cash flows from your operations plus your investing, which is the zero that I didn't put anything, plus your financing. And you're gonna have see what are your future cash flows for the next years. And in the first year, it's usually negative because it's the investment that you and your partners put in the company. So these are two very important concepts in accounting and in financing, which are the IRR, the internal rate of return, and the NPV, the net present value. And the internal rate of return is going to show you what is, well, it's very explanatory, but what is the return that you get from your investments in your company. So for example, if my investment is $1,000 now, I'm gonna get a geometric average of what are my returns in the next years, okay? And then my net present value is how much your future cash flows are worth right now, taking into account the opportunity costs that we put right here, this interest rate. So how much my future cash flows are worth right now if I understand that instead of putting it into this company, I could have invested the same $1,000 or the amount that you use for opening the company in the stock market. And so this rate, the interest rate we use here, we call it also discount rate because we're bringing the future values back to today by using that rate. Okay, so usually I go a little bit more into the details of why is this so important for the investors, for the administrators, and for the ones that are giving, like for the bank, right? But I think I went through it while I was talking here. Awesome. Okay. So you have my email, and I am more than happy to continue the conversation over there. And yeah, thank you so much, Andrea, for the logistics today. And I am very glad to continue being part of the TIC America's family.
Thank you so much, Romina, for everything that you share and for our audience to be here. Thank you so much, everyone, for being here, for your time. Thank you, Romina, again, for everything that you share with us. And have a great day, and thank you so much.